So maxing assignment is to create an income statement and also do a break-even analysis. So there are some information provided in this assignment. It is a company that makes kitchen table. It has 1,000 square feet. You have all this information as part of the assignment in the Word document. And what I like to do today is to show you the solution for both part A and part B. And this way you can check out your answers and you can self-grade your results yourself. Okay, so I'm going to use Excel and show you the format and how to do it. So one of the suggestions I would have for any problem-solving situation, obviously this one is not that complicated, but you could do this thought process for small, simple problem, more complex problem. So what I typically like to do is that I take the information that I have for a situation, or in this case this problem, and on a piece of paper on the left side, I would put down the information that is provided in the problem. And on the right side, I would put in information that I'm trying to solve. So what I have done on this Excel spreadsheet, on this tab, which is for part A, on the left side, I have listed information that the problem gave us, from quantity, the price, the factory size, the rent per month, the utilities per month, facilities per month, and so on. And on the right side is the income statement. So I started with obviously just a format, and then I started to build in the formulas on the right. So for example, in the case of sales, if I click on the sales just to show you, sales is a combination of how many do we sell, which is a quantity, and at what price. So this price times quantity. So what I did was I put in a formula there, and if I show you what do I mean by that, I can use this thing that will show me where the formulas are coming from. So the formulas would be quantity times price, and that will give me that information. Now the benefit for doing this thing by formula and not using a calculator and plugging in the number is that if I want to change in a business that, let's say instead of 5,000 chairs we only sold, say, 4,700, I can change that number and everything else will change, including the break-even, including the net income statement, and so on. So that's really the benefit for using Excel for some of the business and financial analysis. The lumber is also function of how many tables or chairs we're going to make, and obviously how much does each chair require for the lumber. So if I show you my formula, you can see it is coming from the quantity and also coming from the lumber per unit. Look at the supplies, same thing. I need number of quantity and how much am I spending per table for supplies. For labor, you have three pieces to the puzzle. Obviously, you still need the quantity, how many chairs you're going to make. But we also need to know is how many hours will it take to make it, and then how much are we going to pay per hour. So here you have three things coming in to calculate that number. Then we can subtotal to see how much are we spending on cost of goods sold, or also called the variable cost. And obviously that's going to be sum of these three pieces: lumber, supplies, and labor. Gross profit is how much money we have left over after we have spent producing it. How much is the difference between the sales and the cost of goods sold. Depreciation was provided in the problem. Then we're gonna calculate some of the operating expenses. So rent, for example. Rent, I need to know obviously what is the size of the facility, how much am I paying per month, and because it is per month, if you can see this thing on the top over here where the formula is, I also multiply that by 12 because it is going to be, the income statement is for the whole year. Same logic here for utilities. You have your facility size, your utilities per month for costs you're going to spend, and also multiply that by 12. Same thing with the facilities. Now we get into the staff and the faculty, the accountant and the supervisors, etc. So here, again, I need to know is what am I spending. So what we have done on this side over here, on the left side, is I basically said, okay, how many employees do I have for supervisor, accountant, sales, how much we're going to pay, and then calculate the total cost here on this side. And so basically I'm taking those here, and this times here, and this times here, and then we can pull this information over here as we on this side. And same thing with the salespeople, same thing with the accountants and so on. And the value here is that if we decide that we want to have maybe instead of one accountant, we had two accountants. If I change that number, everything else will change. Okay. Then we get into the EBIT, which is the profit or earnings before interest and taxes. So that would include obviously the money we got after we spend money for cost of goods sold. From there we subtract the depreciation, we subtract our facilities related costs, we also subtract the total salary, and we're left with 180. Once we have done that, now we think of then we got to figure out the interest, which is the money we are paying, interest only loan in this case. So we need to know the amount of money we are borrowing, which is $500,000, and the interest rate is 5%, so we get $25,000. Now EBT is the earnings before taxes or profit before taxes. So this is now we're going to take, we calculate the EBT before, we subtract the tax interest from it, and we get the EBIT earnings before taxes. Next thing is the taxes, and the tax is 25% tax rate. So we take 25% of the profit before taxes, and we get that number. That brings us to net income. Basically, now we have everything that is we are paid for, taxes including, and that's the money that we make net income. Below here is the return on sales, which is net income divided by sales. So that would be you're looking at your net income divided by sales. Typically that should be shown in percent, so I'll change that. Maybe put in a couple of zeros, so it's 5.17%. Then in order to calculate the break even, we need to split the total cost between variable cost and fixed cost. So the variable cost is going to be cost that was to make the product, your lumber, supplies, and labor, and so we can take it from the total cost of goods sold, which includes all those three pieces. Fixed cost is everything else basically, so we can add those pieces up, and then the next thing is obviously the sum of the total, which is the total cost. Okay. In order to calculate the break even, we need to know the variable cost per piece. And so we basically take our variable cost of total variable cost, which is cost of goods sold, we divide it by the quantity, we get the variable unit cost. And the formula for calculating, as you have heard on the different recording for break even, is that you're basically taking your fixed quantity and you're dividing it by the difference between the price and unit variable cost. So if I look at the formulas, you'll see we have all these fixed costs coming in here, obviously. And you got the price coming from there and the variable cost coming from there, and that'll give you the break-even quantity. So what that means is that if we sell 4139 chairs, we basically will be break-even, which means that our earnings before taxes will be zero. So if we want to, if I check the exact number, obviously it's going to be probably a little fractional. So let's look at that for a second. Obviously, but it rounds to 4139. So let's say if I put in 4139 as a quantity instead of 5,000, and you will see that the earnings before interest and taxes is 20. It's not exactly zero because obviously I'll have to put a fractional number in there. But you can see that that means that if I sell it at that quantity, that will be a I will be making no profit or no loss at that point. Okay, so that's how we do it. Now, the next assignment was to say, okay, what if we take this and now we say that we are going to forecast for next year, and let's say that the marketing people came and said, okay, if we can lower the price by 7%, we will increase the quantity by 10%, and obviously we have to also account for next year's inflation and so on. So the problem statement is that the salary, labor, material, etc. will all grow 3%. There is no change in rent and facility related cost. Assumption is that maybe they had a long-term contract for the fixed rent. Utility will go up by 3%, and in interest and the depreciation will stay the same. Again, calculate the income statement and the break even. So now we have to account for those parameters. So same logic, same approach. Left side information that we do have, right side information we want to calculate. So now the thing that we are adding over here is, first thing we have to do is to calculate the new quantity and the new price. So up here I said, okay, 10% growth rate and 7% lower pricing will result in 10% growth rate, and the inflation is 3%. So in order to calculate the new quantity, we have to account for obviously the growth rate 10% and the original quantity, so now it is 5,500. For price, we are taking the old, but we're reducing by 7%. Instead of 450, we'll sell it at $418.50. 3% is the growth rate number they gave us. So now we have to calculate each one of them. Okay, so for example, for sales, logic is still the same. We need the quantity, but except that we will be basically growing it by 10%. So this should be up. So the quantity now is going in sales are going to be higher because we're selling more but at a lower price. So we have to account for both prices and the quantity. So here the notation I have means that in that formula, compared to what we did before, you know, we have to account for the quantity for number of chairs we're going to sell. We also account for both price and quantity. New price and new quantity have to be used. For lumber, same logic as we did before, except new quantity, you know, per table, so 100 times that, except you're going to add 3% more for the inflation, so that is included in there. For supplies, you know, supplies, same thing, new quantity, inflation 3% and per piece. Labor, similar logic, new quantity, inflation, but in here obviously we have to account for both labor hours and cost per hour we're going to pay. And then we add them up just like we did before. In the case of rent, we said there is no change. NC over here, the notation means no change. Utilities, we said is going to go up by inflation, so obviously we got to account for the inflation. Again, size of the facility per month, there is a 12 in there also to account for the year, and then increasing by 3%. Same logic for facilities, and but we said for the case of facility and parking, we said there will be no increase in growth rate. We have fixed contracts. That's what this one, based on the assumption, and this one over here, we are not accounting for inflation because the problem statement was that the rent and the facility parking will not go up with inflation. Then we go add them up, just like the same thing with the supervisors. We got to account for the inflation. So what you want to do is obviously someplace have the information. You can put them on the top, you can put them on the side, but at least it's visible and so on. So now, if you go through the whole logic, obviously we go through the same thing, come up with the EBIT, taxes, so on. Net income is 13.2. Now, you know, 13,200. So here we increase the quantity. We're selling 5,500 versus 5,000, but we lowered the price. Now, you know, so the question really to think about it, is that strategy really increasing or decreasing a profit? So let's look at what we had before we lowered the price and increased the quantity. We were making for 5,000 tables, we were making a net income over here of 116,250. 116,250, and whereas now, if I make it a little bit bigger so you can see it, Now, by even though selling more pieces, but we're selling it for less price, our net income is lower. Whereas before it was 116,000, now it is only only 13,200. And as you would expect, that will also drive the break even up. So the break even, which was 4139 before, rounding that number to 4139. Let me just round this. 4139. Now it is going to be much higher. It's 53.75. So basically, it means that if one was going to consider doing this, raising the price, lowering the price by 7% and increasing the quantity by 10%, this would not work. Okay, and so this is where one can kind of start to say, okay, how would one use analysis like this? So for example, one can say, okay, what if I can sell, instead of 5,500, suppose we sell 7,000. Okay, so, and I'm sorry, backward over here. So suppose we were selling more. And obviously, as you increase the quantity, if you're making 6,600, so the punchline over here is that by just increasing it by 10%, 5,000, 5,500 doesn't do it. One will have to tell the marketing people or sell a lot more in order to get this thing right. So what you are going to do is you are going to grade yourself. So everybody that attempts to do it get 50%, half a grade point for this assignment. Then you should compare each one of these things where I have 5%. For everything you got right, you give yourself 5 points. So eventually you can add them up and you'll get to a total of 100 points for the assignment, and then that would be 100%. So you can self-grade yourself, email your self-grading to your professor, and the professor will put it into the Canvas. So I hope this is helpful.